Hello, this is Ken with Ken's Insurance Agency. We're talking about life insurance and retirement planning and financial planning tonight. Um, there are three main things we're going to be talking about: life insurance, annuities, and qualified plans. Let's start with life insurance. Life insurance is broken up into two parts. There's temporary life insurance, and then there's permanent life insurance. On the temporary side, you have term life insurance, which is great for people who are first starting out, not got a large budget. Um, it's temporary, usually anywhere from 5 years to about 30, 35 years. Um, let's see here, has no cash value, great for mortgage protection. Um, if it's structured right, you can get all your premiums back at the end of the term if you haven't used them. Can come with living benefits. The next of our policies is the permanent life policies. Um, we'll start with whole life. Whole life can be guaranteed issue, or it can have underwriting. It's got cash value, but you don't get the cash value when you pass away. Covers you up to age 100. When you turn 100, it becomes MEC'd and basically pays out the death benefit. Um, let's see here. Great for final expense. Earns about 4% on average. Loans are about 3% on average. Um, we don't recommend taking loans with this type policy. Can be more expensive than the other permanent types of life insurance. The next would be Universal Life, another great final expense type policy. Um, Usually earns about 5% interest. Loans are around 3.5 to about 4. Um, Also can be used for retirement planning, although it's not the best for this. Um, Although some of the other structures of it are great for it. Um, Issue ages are generally 14 days to 80 years old. Face amounts can be anywhere from about 10,000 to $1 million. Final expense would be anywhere from 3,000 to about 100,000. Although most final expense policies have stopped issuing at 3,000 unless they're guaranteed issue. Um, can come with living benefits. Most of our policies come with living benefits when we do sell them. The next one is variable universal life. This type of policy requires a securities license. Interest can be negative, so basically you lose some money, to very large positive, loaded in fees because of it being tied to securities. Um, this policy can cancel out because of the loss in the market, because it's heavily tied to the market. Um, the next is guaranteed universal life. This is basically a universal life policy that's guaranteed to last for your lifetime. Usually written to age 121, but if you live past that, it will still cover you. Has cash value, both universal life, variable universal life, and guaranteed universal life. And our next one, index universal life, pays the cash value plus the death benefit, minus any loans and interest on loans that have not been paid yet. The next one is index universal life. Interest on it can be 0 to 13%. You share in the market's upside. You don't share in the market's downside generally. Makes it great for retirement planning. On average, the interest rate for this product is around 5 to about 8%. On average, loans are around 4%. Great retirement vehicle, especially when structured right. So these policies are great and stuff. They can be used universally. The next set of policies we want to talk about is going to be the qualified plans. These are what most people are used to from their work. Like a simple or a 401k or an IRA. These type of plans are really dead. Most economists say don't invest in them. Say that now the best thing to invest in is annuities, which we'll cover next. The problem with these is you get some of the upside of the market, but you also share in the downside. So you can lose a good portion of your initial investment and a good portion of the money you made whenever the market goes down. So it's a bad investment. It really is. The next product we want to talk about is annuities. Annuities can be broken up into immediate, fixed, variable, and indexed. And we're going to cover each of these. An immediate annuity, basically you put your money in and then within the next month it starts paying out. And it'll give you a lifetime income. So this is great for somebody that's 65, 66, 67 and retiring, to give them that lifetime income. They may also want basically some that's going to be deferred for 10 years so that they get some growth and then it starts paying out. The next is a fixed annuity. Think of this basically like a CD. It's going to pay anywhere from about 2 to about 5%. And it's basically a deferred type of annuity. You put it in, you let it set and grow for about 5-10 years, and then you start getting your money out. The next type is a variable annuity. These are good for very young people, heavily tied to the stock market, so it's up and down, can basically collapse to where you don't have anything because of the market going down. Heavily loaded in fees again. Fees get assessed whether you make money or lose money on the variable products. The next is a indexed annuity. With indexed annuities, you get the upside of the stock market without the downside if structured correctly. It's a great product, great retirement vehicle. It is deferred, so basically you want to have it for at least 5 years. before you start drawing off. Recommended is 10 years at least. These can be also used as legacy type. So basically, if you want to leave them to like a grandkid or to a charity, you can do that. They can be structured for lifetime income. On the fixed ones, like index, fixed, and immediate, if you do lifetime income for you or you and your spouse, then you're going to have a small fee. That fee is anywhere from 0.2% to about 2% interest. It's very small. Can be up to 3%, but I've rarely seen it 3%. So you really want to look at what you're wanting to use the money for. If you're wanting it for a legacy, we don't put that rider on there. So you have to be clear what you want up front so that we can actually know how to structure it and do. You can actually have where we basically mix the types of annuities. So we have some for legacy, some for safe growth, and have some for retirement, which is what we really like to see because it gives us a mixture of investments and investment types, which help us out. If you would, please get with us. We can give you more information. We give free policies, free quotes, free consultations as a financial planner and as a retirement planner. So get with us. Call Ken at 662-292-6271 or go to our website, kensinsuranceagency.net, and schedule an appointment to speak with us. We'll be glad to help you. And we are able to help you if you're in Mississippi, Tennessee, Arkansas, Louisiana, Alabama, or Michigan. And we are working on adding on more states. So if you're in another state, feel free to contact us. We do have partners in all 50 states to where we can help you. Thank you and have a nice day.